One of the biggest tax planning opportunities in retirement is missed so often because it's really difficult to spot if you don't know what you're looking for. In this video, we're going to dive into what we call the opportunity zone, a period of time in early retirement with major tax planning potential. Stick around to learn how you can spot this opportunity for yourself, why it's so important for tax planning in retirement, and 3 ways you can use the opportunity zone to pay less taxes in retirement. Let's dive in. Tax concepts are so much easier to talk about when we draw them out. So let's sketch this idea of the opportunity zone so we have a nice visual representation for what that means and how it works. I have here for us a timeline, and this is an 8-year timeline showing in the blue columns our last 2 years of work. The higher the column, the more income in that year. So we have our last year of work right here, and then a drop in income illustrating retirement. You have some kind of meaningful drop in income. Your experience may vary. You may not have a very significant drop in income, but to illustrate the opportunity zone, we need to show a pretty significant drop in income. So the green columns can really be any type of income that would wind up on your tax return. It could be IRA withdrawals, it could be dividends and interest. It really doesn't matter. Just an illustration. What's important here is that we show an increase in this income as retirement goes on. First, we're going to show Social Security starting after a couple of years. And then on top of that, another source of income is going to be required minimum distributions, RMDs, from our pre-tax retirement accounts. This is a really common flow of income in early retirement, especially for many of our clients. And why we focus so much on this time frame. Not only is it important simply because we're making a major life work and income transition, but if we expect and plan ahead to have an income pattern that looks like this with this dip, this significant dip in the middle here, there are some really incredibly valuable tax planning opportunities to be had if we can recognize it when it's happening. This gets really interesting when we overlay a tax bracket onto this flow of income in early retirement. And just for simplicity purposes, let's call everything below the line here the 12% bracket, and everything above the line the 22% federal income tax brackets. We use these two, number one, simply because many of our clients in retirement find themselves in one of these two brackets. Number two, because the jump from the 12 to the 22 is the largest tax bracket increase going from one bracket to another. So it really illustrates the power of the opportunity zone and the planning around taxes that it offers. So what we see when we overlay this tax bracket here is we have a number of years here right after we stop working where our income is far below the top of the 12% bracket. And we know that in a couple of years, we're going to be back up into the same tax bracket we were while we were working. Again, a really common scenario that we see with our clients. So this area right here is what we're focused on, the opportunity zone. These number of years where we are going to be in the lowest tax bracket we're ever going to be in, and it's very likely that we're never going to be in it ever again. So while we're there, if we're strategic, we should take advantage of that and not let that time period pass us by. So we understand the opportunity zone. It's this period of time right after we stop working where our tax rate is relatively low compared to where it will be in the future once Social Security and required distributions start. Again, it very likely looks different for you. You may have a longer period of time. Or you could have a shorter period of time. I illustrated 4 years. You might have 6 or 7 or 8 years before you start Social Security and required distributions. You might have a little bit of a gap in that lower bracket. You could have a lot of room before the top of that 12% bracket. It's going to look different for everybody. We're just illustrating it simply and easily here today to grasp the concept. So if we're going to be able to take advantage of the opportunity zone, there are 4 really critical steps that we have to take to be able to position ourselves to make the best use of the time we're going to have in that low tax bracket. First and foremost, we have to know in advance if we're going to be in that lower tax bracket. For many people, we simply don't have this opportunity available to us. If we had to start Social Security up here simply because we need the income, obviously that's going to fill this lower tax bracket and we're not going to have the opportunity zone there to do some strategic planning. It's important to know what this is going to look like for us when it's going to appear, and it's really critical to know that before we're there. For our clients, we're thinking about that on the far left side of the chart as far as we can get, so we can start planning ahead to really double down and take advantage of that time period. One way we might do that is, for example, setting aside cash as we go along here in our working years to use to pay tax on Roth conversions we might do during this time period, or setting aside cash to use to cover our expenses so we aren't using types of income that would cause us more taxes, meaning pulling from our IRAs or anything like that. So first and foremost, we have to know in advance before we're here whether or not this is going to be an opportunity for us. And the only way you can do that is if you understand a couple of things. Number one, how much income am I going to need once I stop working? We have to have a really good understanding of what we're going to need to cover our basics every month, what we're going to need to cover our discretionary expenses, travel, charitable giving, gifts for the kids, whatever we're going to do. We have to understand what that income need is going to be, because the next step is we have to understand where we're going to get that income. Where we get that income is going to have a direct impact on how much space we have here to do planning. If our where is IRAs, that looks a whole lot different than if we're going to be pulling from joint accounts or other after-tax accounts, or from our Roth, or from cash. So not only do we need to know how much we're going to need, we also need to understand where we're going to get it. Really important, critical piece of the puzzle. This is a step that a lot of folks miss. We're focused on how much income I'm going to need and if I have enough money to support it, but we're not thinking about where that money is going to come from and how that impacts my planning capabilities in early retirement. Fourth and final step here is we have to know how big our own personal opportunity zone is. Some folks are going to have a lot of space. For some people, their green columns might be way down here and they have a whole lot of space to fill for tax planning purposes. Other folks may have higher green columns and we only have a little bit of space. Some folks may have a really long period of time. Some folks might have a really short period of time. It's going to look different for everybody, but it's really critical for you to understand how much room you're going to have year to year and for how many years you're going to have it so you can plan ahead accordingly. One important concept to talk about here as we are mentioning that everyone's opportunity zone is going to look a little bit different depending on your income right after you retire. It's important to understand that you might have the opportunity to create more space in that lower bracket. Again, if you're thinking ahead and you're strategic, that may look like delaying Social Security. If we push Social Security ahead, Not only is that going to help our benefit grow, but it's also going to create more space in that lower bracket for planning opportunities. That might also look like not pulling from our IRAs early in retirement. Our IRAs, especially our pre-tax IRAs, are going to be completely taxable. Whatever we pull out is going to fill up that 12% bracket, and we're going to have less space in there. So we may have to think about funding our spending in a different way. Again, if we're trying to create as much space in that lower bracket as possible. It may mean we shouldn't be making sales and realizing capital gains in our after-tax accounts as well. Again, another way that we can fill up that bracket. So again, you may have opportunities to be strategic with the income you have control over that's going to wind up on your tax return, to create more room and more planning space and make your opportunity zone either longer or deeper, or both. You may have a chance to do both at the same time. Either way, again, it all goes back to looking ahead, understanding whether this applies to you as a concept at all, how much income you're going to need, more importantly, where it's going to come from, so you have a really good, clear picture of the planning opportunities you're going to have at your disposal. Let's talk about 3 strategies that you can use to maximize the years that you have in the opportunity zone so you can pay less tax and be strategic in early retirement. The first strategy we're going to hit on here is focused on where you should pull money from if you needed to cover your living expenses in early retirement. Again, thinking about the idea that we're in a relatively low tax bracket to where we will be in the future, and if we need more income simply to do our travel, cover our basic living expenses, whatever it is, this first strategy is focused on pulling that income from our pre-tax IRAs. Focusing on pulling income from our IRAs up to, if we need it, the top of this low tax bracket. Remember, every dollar that we pull out of our pre-tax IRAs is going to go on our tax return as taxable income. So if we need an extra $1,000, $2,000, $3,000 a month, however much it is, pulling that money from our pre-tax IRAs, knowing we have to pay tax on it, choosing to do it when our tax rate is relatively low accomplishes a few things. Number one, we get to pull it out and have it be pretty tax efficient. We're paying a relatively low rate. That's not so bad if we need the money. Another positive outcome of doing this is that it lowers our overall IRA balance and helps to bring down the required amount that we're going to have to pull out down the road, allowing us to have less income in the higher tax bracket in the future. So there's a couple good reasons why, if we need money, we would pull from our IRAs at this lower tax rate, knowing that if we pull from them and use them in the future when we're in a higher tax rate, we're going to have a higher tax bill. Quite simple and straightforward there. So again, less of a tax strategy, more of an income strategy with a little bit of tax strategy sprinkled on top. So first opportunity we have, if we need more income, we can pull it from our pre-tax IRAs early in retirement. If we need income then above that 12% bracket, a good opportunity to use more tax efficient funds. We could use cash, we could use our joint accounts or individual after-tax accounts, knowing that the capital gains tax rate is lower than our 22% tax bracket rate. So we can switch our strategy when we make that leap, if we make that leap over into the higher tax bracket. But while we're down here, pre-tax IRAs are a good source of income if we need it. The second way we can take advantage of the opportunity zone is doing Roth conversions, taking some of our pre-tax IRA money that we haven't paid tax on yet and choosing to pay tax on it while we're in a relatively low tax rate. This is a really common strategy, lots of information and videos and resources out there on Roth conversions. with just as many opinions on whether or not they're a good long-term tax strategy as well. We're not going to dive into all the details and intricacies in this video of Roth conversions. We're going to keep it high level and simple. But we spend a lot of time with our clients considering whether the opportunity zone is a great time for them to pull some money out of their pre-tax retirement accounts, pay a relatively low tax rate, move that money into a Roth where it can grow tax-free into the rest of their retirement. So our next tax strategy here is filling our opportunity zone with Roth conversions. Again, the concept here, if you're not familiar, is we know down the road we're going to have to pull out a minimum amount every year and pay income tax rates on our required minimum distributions from our pre-tax IRAs. If we know that to be true for us, and we have this limited time in a lower bracket, maybe it's a great time to shift some money out of our pre-tax retirement accounts that are going to cause our RMDs pay a lower tax rate, and then shift that money into a Roth IRA where it can grow tax-free. A simple illustration for those of you who are new to Roth conversions. Again, we're going to keep this really simple and straightforward. If we have our pre-tax IRA, again, this is all money we have not paid tax on yet. We would pull out a certain amount, let's say $20,000. We pay tax, we pay income tax at our tax rate on that amount of money, on $20,000. Then it comes down here and goes into our Roth IRA. So we go from pre-tax, we pay the tax, and then we go into our Roth IRA. A great way to make use of this relatively low tax bracket in early retirement in our opportunity zone here, where we can shift from pre-tax to Roth, avoid doing that more up in the 22% bracket, do it down here in a much lower bracket. Again, this is really similar to the withdrawal from our IRA strategy. The big difference is to make the Roth conversion make sense, we have to be able to say, well, we don't need to spend that money that comes out of our IRA. We're going to pay tax on it, but we're not going to spend it. We're going to shift it over into Roth. Whereas the strategy we talked about first was to pull from our IRA because we need that money to spend. Big difference between the two. All depends on how much money you need every month to determine which one is better for you. So again, great opportunity to convert some of our not so tax efficient IRAs to Roth IRAs. A third and less commonly used strategy for making the opportunity zone pay off for us is using that time in the 12% tax bracket. And again, this only applies if you're actually in the 12% tax bracket, to realize long-term capital gains. Many people aren't aware of the fact that if you are in the 12% tax bracket or below, and you sell an investment in a non-retirement account for more than what you bought it for, you can avoid paying that capital gains tax as long as it's a long-term capital gain. As of today, long-term capital gains rates are either 0%, 15%, or 20%, depending on your income. The opportunity to pay 0% is if you're in or below the 12% tax bracket. So this is a great opportunity for those of you who have individual accounts, joint accounts, if you've been gifted stock and those investments have gone up in value as the market's gone up, and you feel kind of trapped in these investments that you know if you sell them, you're going to have to pay capital gains tax. Well, if we find ourselves with space in this 12% tax bracket, it may be a great opportunity to sell some of those investments that otherwise we would have had to pay capital gains tax on the money we've made. We can sell them in the 12% tax bracket and potentially avoid that capital gains tax. So a third way we can use our time in the opportunity zone is to realize capital gains. Again, just to illustrate that capital gains concept here, let's say we bought XYZ stock. We bought XYZ stock when it was $10 a share. And we bought it at a really good time because today it has gone up in value to $40 a share. So we've made 30 bucks. If we don't sell XYZ stock, there's no tax implications for that increase in value. However, if we did sell this $40 share of XYZ stock, we're going to have to pay capital gains tax on what we've made. And as of today, that's either 15%, 20%, or 0%. We're talking about this opportunity to pay 0% in tax if we do this in the 12% tax bracket. So, great time, again, to potentially fund our living expenses by selling off some investments in a joint account or an individual account, and you turning those investments into cash. You know, if we sold XYZ stock here for 40 bucks, we could, again, in the 12% bracket, we could avoid tax on that $30 in gains, and we could use that to fund our lifestyle or spend in another way. Where otherwise, if we were to wait until we were in the 22% bracket, we'd have to pay that capital gains tax at 15%. So again, maybe not as valuable a tax strategy as the Roth conversion, simply because we're avoiding 15% tax on our gains rather than 22% on our RMDs, and maybe not as valuable as using our IRAs to fund our spending, again, because we're avoiding the 22% bracket instead of 15% capital gains. But for those families who have a fair amount of their wealth in after-tax accounts as opposed to IRAs, 401ks, and pre-tax retirement accounts, this can be a great opportunity. We actually have a client who was in that very same situation. Most of their wealth was in after-tax accounts. They retired, and we were debating on whether we should start Social Security or not, which would have looked like moving this Social Security up here. And she had been gifted over time many shares of a really large company's stock, had done nothing with it. It had gone up in value immensely, and she always felt like she couldn't do anything with it because if she used it, she'd have to pay capital gains tax. So she found herself in a very similar opportunity zone situation, and we said, hey, what if we could defer Social Security? She needed income, which is why she was thinking about taking Social Security. But we said, hey, what if we deferred Social Security, which is a smart move for her, and we sell off some of that inherited stock in here to fund your lifestyle, and we can avoid the capital gains tax on it. Doesn't make sense for everyone, made a whole lot of sense for her, and we've been doing that for a couple of years now. Again, just a unique situation where realizing capital gains here really pays off. So again, in the hierarchy here of which tend to be better and more impactful, Roth conversion and pulling from our IRA for spending are probably higher than minimizing our capital gains tax, simply because the rates are different. We're avoiding 22% with the other two, and we're avoiding 15% on the capital gains side of things. But all of these could have a really big impact on the amount of your wealth that you get to keep, rather than paying income tax down the road once you're in a higher bracket. All right, let's summarize what we talked about here in this video. Number one, we talked about the opportunity zone itself, which quite simply is a period of time in early retirement where you're paying a lower tax rate than you will in the future. It's really as simple as that. It may look different for you than somebody else, but if you're going to be for a set number of years in a low tax rate, you're in an opportunity zone of your own. We also talked about what you need to do ahead of time to really capitalize on that period of time and maximize your tax savings potential. Number one, we have to understand how much income we're going to need to fund our lifestyle so that we can plan ahead as to where that income's going to come from. Again, the more income we can have without it showing up on our tax return, the more room we'll have for tax planning and maximizing our strategies in that lower bracket. Again, we can only be strategic if we know how much we're going to need every month or every year, so that we can choose the appropriate sources of that income to maximize our planning opportunities. And lastly, we talked about 3 ways that you can use the opportunity zone, capitalize on that to implement real solid tax strategy. The first one we talked about was using our pre-tax IRAs to fund our lifestyle expenses. If we're in a low bracket, it's a great time to choose to use our IRA money that we haven't paid tax on yet and pay as little as possible. Second, we talked about Roth conversion, choosing to pay tax on portions of our IRA balance at a lower tax rate to bring down our IRA balances, minimize our RMDs, and put more money into our Roth to grow tax-free into the future. A lot of good reasons why that would make sense in the opportunity zone. And lastly, we talked about realizing capital gains while we're in that 12% tax bracket. Again, capital gains tax isn't due when we sell investments at a gain in our joint individual after-tax accounts if we're in the 12% bracket when we make those sales. So again, a great opportunity to be strategic with which accounts we're using to maximize the opportunity zone for ourselves. At the end of the day, the point I want you to go home with is it's important before you retire, before you're in the opportunity zone, to understand your income sources enough so you know if this area of planning is important to you and relevant so you can maximize your tax planning potential. Thanks for joining us for this video. Until next time.